All right, in today's video, we're going to be talking all about delta. For you option traders out there, don't know what delta is. Delta is one of the Greeks, one of the byproducts of the option pricing formula, and it's one of 5 Greeks. You got delta, theta, vega, gamma, and rho, but it's also the most important one, in my opinion, delta. So you want to understand what delta is. Before trading any option contract, whether you buy an option or sell an option, you want to know what the delta is. The delta can help you decide which strike price to choose, which strike price to buy or sell, because it's going to tell you how much that option value is going to change in conjunction with how the stock moves. So I get a lot of questions from people saying, Lee, I don't understand what is delta? How can it help me with my own trading? So in today's video, we're not only are we going to talk about the concept of what delta is, we're also going to talk about how it affects an options value and how you can use it to make better trades yourself. All right, so let's just jump right in and talk about what delta is. All right, everyone, Lee Lowell here from smartoptionseller.com. What you see in front of you is the Smart Option Seller Guide to Delta. Okay, I got my Word document. We call this a cheat sheet. So basically, delta is, there's 3 definitions for delta. And the first one is really the most important, okay? And let's just go over what it is here. And then we're going to look at an option chain. We're going to look at an option calculator as well. I'm going to show you how delta affects the option price and how things move as the stock moves. So delta, the number one definition of delta is it's how the option price changes in conjunction to how the stock price changes. That's very important. All right. The second definition is, what is the chance of the option finishing in the money at expiration? That's the delta can tell you whether the chances of the option will finish in the money at expiration. Being in the money means that option has value at expiration. Now, it doesn't mean that the trade is going to be profitable. It just means it's in the money. Okay, and I'll show you that as well. And the third definition, and this really pretty much only applies to floor traders and professional traders, it's how many contracts or how many shares of stock or futures contract, the way that I used to do it, to make you hold a delta neutral position, which means you're not bullish or bearish. It's just a flat position. So, if you buy a call option, which is a bullish strategy, how many shares of stock do you need to sell to offset that bullish position? And that's what the delta can tell you. We're not really going to talk about that. We're going to talk about the first two definitions more than anything else. But once again, the first definition to me is really the most important, and it will help you understand how your option value will move in conjunction to the stock price. Now, a couple other items down here. Deltas range from 0 to 100%. And the higher the delta, the more responsive the option price is going to be in conjunction with a stock move. So you have to decide for yourself, how much movement do you want to get out of your option price? And it'll be determined by how much you really want to spend and how bullish you are, or what your expectations are of how the stock's going to move and how fast that stock's going to move. Okay. And then, using an option calculator can help you with what if scenarios. So let's just jump right in here and talk about and show you how deltas work and what they are and where you can find them. Now, what you're seeing in front of you is an option chain. Is from the broker that I use, Interactive Brokers. Call options on the left, put options on the right. So we're only going to focus on call options here. We're looking at Apple. Okay, we're going to focus on Apple options. Now, before we look at the options, let's just bring up the chart real quick of Apple. Here's a 2-year look back period of a daily chart of Apple, closed just below $230 a share. Let's just say you're bullish on Apple. You want to take a bullish trade. You're not going to buy the shares. You want to buy a call option. Buying call options is a bullish strategy, so that's what you're going to key in on. Now, if you ever look at an option chain, there's so many different choices of which option contracts you can buy, and that's listed in the strike price column. We'll show you that. So you have to figure out which strike price should I buy because I'm bullish. Okay, so let's go back to the option chain here. So here's your strike prices. This is just a portion of the strike prices that are listed for Apple for the January 17, 2025 expiration. It's got 54 days until expiration. So you're bullish on Apple. You think it's going to go higher. You don't know how high it's going to go. You just think it's going to go higher. So a lot of people will get confused and say, well, can't I just buy any old call option and I'll make money on it if the stock goes up? There's a yes and no answer to that, and it will depend on how quickly the stock moves in your favor, or not moves in your favor. So that it's very important to understand how the option price will change in accordance to the stock price change. So what you want to do is you always want to have, if you're looking at in your own options option chain, you want to make sure you have the delta column. Okay, so you can see here, here's the strike prices, here's the delta column. The lower the strike price, meaning, here's the stock price. The lower the strike price below it means it's more in the money, the higher the delta is going to be. And the deltas, you can see, these 180 calls have a 98.4% delta. It's 0.984. That means 98.4%. Deltas go up to 100. So this is a pretty high delta. So that's an in the money strike, the 180 strike. So here's the last price for Apple, just under $230 a share. The 180 strike is listed well below the current price of the stock. That means that call option is in the money. So it has a very high delta. If you scroll down the option chain, you look at these 275 calls, only has a 1.5% delta. Very, very small delta. This is an out of the money strike. 275 is listed well above the current price of the stock. That means that call option is out of the money. And at the money strike is the third one. You got the out of the money, in the money, and the at the money is the strike price that is closely resembling the current price of the stock. $230. Here's a 230 strike. So those deltas are typically right around 50%. In this case, it's 56%. So the first definition of delta that we've talked about is how much the option price will move in conjunction with the move in the stock. Now we compare it to a $1 move in the stock price. That's just the easiest way to look at it. So let's look at the 230 calls. The at the monies has a 56% delta, or 56 cents, we can say in this case. So for every dollar that Apple moves up, this option value will move up by 56 cents per contract. Okay, that's $56. Okay, so each option contract is based on 100 shares of stock. So in this case, let's say this is how it went out on Friday, November 22nd, 2024, 780 bid at 805 per contract. That's actually $780 at $805. If you want to buy this thing somewhere in the middle, let's just say we can buy this thing for $8 per contract. That's an $800 outlay. That will cost you $800 to buy one contract. Versus if you bought 100 shares of Apple, that'll cost you roughly $23,000. So you're getting you get to control the same 100 shares of Apple for $800 with a delta of 56%. So if Apple jumps up by $1 per share, this contract at 230 calls will go up by 56 cents per contract. Okay, so it's going up by about 56% of that. This thing would be worth $8.56 if Apple jumps by $1. Now, if you look at these, let's look at we can look at let's say the 200 calls has just under a 95% delta, meaning if Apple goes up by $1, this option price will go up by about 95 cents per contract. So you're getting almost point for point movement with the stock. But this option will cost you roughly $32.50 per contract. Let's just say somewhere in the middle. We'll use $32.50. That's $3,250 it'll cost you. Whereas the 230 call will cost you $800. But you're getting the difference in the delta. You're going from a 56% delta to a 95% delta. That means if Apple goes up by $1, this option value here is going up by about 95% of that versus 56% of that. So you have to decide, how much movement do you want to get out of your option? You want a lot of movement, like a 95% movement, or do you want just mid-range, 50%? Now, if you choose an out-of-the-money option, let's say the 275 calls, it'll cost you 9 cents a contract, which is $9, 9 actual dollars. But your delta is only 1.5%. So if Apple rallies by $1, this option value is only going up by $0.015. Is that enough movement for you to buy these things? I mean, Apple will really have to go make a big movement in order for these things to really pay off in the next 54 days. So you have to decide. A lot of people will say, I'm just going to buy a cheap option because it only costs $9. And, if the stock moves up, maybe I'll be able to sell it for some money. a profit. Is that how you want to make your trades, by just kind of hoping that the stock's going to go up and maybe you'll make $1 or $2? That's not really how you should play your options. But anyway, so you've got the 210. What were we looking at here? The 200 calls, and you got the 230 calls. So let's look at an option calculator and figure out, how the delta affects the option prices, and depending on how long you decide to hold that option for. Okay, so let's pull up an option calculator. This is barchart.com. You get your free options calculator. Your broker probably has something similar to this as well, but we like to use bar chart here. So here we have, once you open up the bar chart options calculator, it's free. And you type in the symbol, it'll default to the numbers that were there at the end of trading. Okay, so we're looking at a call option. Let's go out to the January 2025. So we're all on the same page here, and we're going to look at. Let's reboot this so it has all the right numbers here from Friday. Okay, so here's where Apple closed, 229.87. Let's look at the at the money, okay? And let's go back to the January. Where's January? Here's the January. Okay, so it has the option value just under $8. So let's kind of make this a little bit better. So we're looking at the same thing. Let's move this up to 20. Let's go 20.8%. You can change some of the inputs, and here's the outputs over here. Here's the theoretical price of the call option. Here's the delta at 54%. So it's a little bit less than what we saw in the option chain, where the delta was about 56%. This is about 54%. And here's the same numbers pretty much. The option's worth 802. So let's do some what if scenarios here and see how the option value changes. Now, if you bought this thing for $8 or $800, you want to know what your break even is. Okay, how do you figure out where you need Apple to go to in order to just break even? Now, you take the strike price 230, add it to the option value, which is 8. So that's $238. So Apple needs to go to at least $238 by expiration in order to just break even on the trade. That's if you're going to hold the trade all the way to break even. Okay, so let's see what happens if Apple stays exactly the same all the way through expiration. We'll take the expiration date down to 0, and you can see that now Apple didn't move anywhere. Same stock price. Your option is worth $0 because Apple didn't, move up to above your break-even price. It's actually below the strike price still. So you would lose $800 on that trade. Let's say that Apple goes up to $235. Now here's what happens. I'm sorry, not that two. This we'd say have to move the stock price, $235. Okay. So it's in the money. You got your strike price is $230. The underlying price is $235. It's in the money by $5. Here's the value of the call option is $5. Now this is where definition number 2 comes in. The option finished in the money, but you still lost money on the trade. You bought that option for $8. Come expiration, on the last day of expiration, it's only worth $5. So you actually lost $3. You actually lost $3 on the trade. Even though Apple moved up $5, which is in the direction you thought it would go, you still lost money on the option trade. Okay, so in this case, the at the money trade didn't help you. But if Apple went up to let's say it went up to 240 on expiration, now it's worth $10 per contract. So you'd make $2 or $200. It's in the money by $10. It's worth $10. That's the intrinsic value. So you bought it for $8. Now you could sell it for $10. You made $200. Okay. So it depends on how far Apple moves up. Now, if Apple moved up to, let's bring it back to 235. Let's say Apple moved up to 235 in 1 day's time. Okay. So remember, you bought it for $8. There was 55 days left before expiration. Now Apple jumped $5 in 1 day because there's 54 days left now. Now it's worth 11. So you bought it for $8. So the very next day you can sell it for a $3 profit. You bought it for $8. Now it's worth $11. But once again, remember, if by expiration Apple stays at those $5 higher, it's only going to be worth $5. So you can see over time the value of that option goes down. So you have to decide, am I going to hold this option to expiration, or am I going to get out very quickly if Apple moves in my favor very quickly? So not only you have to decide on the delta, but your timing is very important as well. Are you going to get out when Apple moves in your favor, or are you going to hold it all the way to expiration? That's, just another decision you have to make. All right, so let's go back to 229.87, the original price. Let's look at the 200 calls with 55 days left before expiration. And what did we say that option was worth? The 200 calls are worth about $32.50 per contract. Let's kind of make things match up here. So it's worth $31.50. So let's just bump up the volatility to, so we got the stock price, the strike price. We want it to $32.50. So let's bump this up a little bit to make everything match up. 32, 31. All right, so here roughly 32.50, 32.47. So it's really on the same page here. So we got the stock price, the strike price, days expiration. So let's just say Apple moved up to 235 from 235 in 1 day's time. Okay. Now it's worth 37 and change. So you've made about $4.70 or $470 per contract that when Apple moved up. Now let's just say Apple stayed at 235 until expiration. We got 0 days left. It's 235 strike price. Now it's worth $35. So on expiration, Apple moved up about $5. You bought it for $32.50. It's worth $35. So you made $250 profit. Whereas if you bought the at the money option and it went up to 235, you would actually lose money. Okay. So there's the thing. The in the money option with the higher delta will hold its value pretty good as long as, the stock moves up a decent amount. Now the break even price was the 200 strike plus the 32.50 that we paid for it. So that means the break even is $232.50 on Apple. So Apple really only has to jump $2.50 in the next 55 days. But do you want to get out quickly, or do you want to hold all the way to expiration? Your in the money options actually will hold its value better all the way through expiration, as long as the stock moves slightly in your favor. Okay, so delta is pretty important. Now let's go back and look at that deep out of the money option, that 275 call with 55 days left. And what was the value of that? Let's bring this back down to 20%. Okay, so the option contract was worth 9 cents. That's what you can buy it for. And your break even is $275.09. So Apple really has to go up about $45 in order for you to make money on that thing. Very low delta. You can see the delta right here is just about 1.4%. The option change showed it at 1.5%. So we're looking at all the same numbers here. So let's just say Apple jumped up to $240 in 1 day. Take this down by 1 day. Now the thing's worth 37 cents. Okay, so you bought it at 9. You could sell it for 37 cents. That's a 28 cent per contract profit. That's 28 actual dollars. Okay, so that's not so bad. And if you bought a number of those contracts, you can actually make a little bit of money. That's in 1 day. So you're thinking to yourself, oh, I'm feeling pretty good. I'm going to wait. I think Apple's just going to keep going. So let's just say Apple goes up to $260 with 0 days left. That option's still worth nothing. Okay, Apple jumped $30 a share. It went from $230 to $260, but you bought this way out of the money call strike, and now it's worth nothing. Now, if Apple jumped up to $260, let's say with 30 days left before expiration, it's worth $1.48. So you can still sell it for some value. So the thing is, if you're buying these out of the money contracts that have a very low delta, the stock really has to go up really far, really fast in order for you to make money. If you hold it until expiration and it doesn't get up to your break even, you're going to lose money. So the bottom line here is that which delta do you want to choose? Okay, do you want to get 50% of the movement, or do you want to get like 95% of the movement? It'll cost you more money, to buy that deeper in the money call option, but you're going to get the movement. So it's going to come down to how bullish are you? How fast do you think the stock's going to go versus how much money you can afford to pay to buy these options? All right, so there's a lot of things involved. But Delta, once again, will tell you how much the option price should move. Let's go back to here. Let's reset everything here. I just want to show you how Delta, make sure that Delta really works the way it should. So we're looking at the January 17th. And the at the money 230 call has a delta of 54%. So I just want to show you how that works. That option value should go up by about 54 cents if Apple goes up by $1. Okay, so what's 786 plus 54? Let me get my calculator here real quick. So we're looking at the actual numbers. So $7.86 plus 54 cents is $8.40. So this thing should be worth $8.40 if Apple jumps by $1. So let's bring it up to 230.87, 230.87. And the option is worth $8.41. So just about what we figured. Okay, so that's how Delta works. It actually goes up. Now, if Apple drops by $1, it goes down to 228.87. It's going to lose about 53 cents per contract. Okay, so you can see how that's how Delta works. Everything else remaining the same except for the stock price, Delta will work as it should. Okay, so that's really your lesson here today. You want to understand what Delta is. It tells you how much the option price should move in conjunction with the stock, but you also have to understand that the stock has to move, by a certain amount of time in order for the option to work in your favor. Now, if you buy a deeper in the money option that has a higher delta, yes, it will cost you more money, but you'll make more money in more scenarios. If you buy the at the money option, you're going to make money in less scenarios. So bottom line here is that the stock really has to move in your favor pretty quickly in order for you to really make money if you're buying like the at the money options or the out of the money options, whereas the in the money options will retain its value faster. But you have to decide for yourself, is it worth me paying more money to buy a deeper in the money option? That's up to you. All right, so I hope this has been helpful, showing you what Delta is. A lot of people have been asking me what Delta is. That's how it works. And just use that first definition of the option price, how much it's going to move in conjunction with the stock price. All right, if you found this video helpful, please give me a thumbs up. Please give me a like, leave me a comment. I make these free videos for the trading community. We all want to become better traders. I'm trying to help you do that. On the screen here, I'm going to put another video or two. I'm going to put a video on about picking the best strike price. Let me see if I have another Delta video I can put on there as well, just to help you understand how these things work. Let's go to our website real quick. smartoptionseller.com. We're all about selling options, mostly selling put options. If you want to understand what selling put options is all about, get our free ebook right here. Put Selling Basics. It's all about what put selling is, why we love it so much. You can scroll down, put your name and email address in here. We'll send you a link with an email with a link in it to the ebook. If you want to learn more about, go a deeper dive into what put selling is, take a look at our video series here, Selling Put Options Like a Pro. Here's what we offer. We have a couple newsletters. We have one-on-one coaching. We also have a probability calculator that you can look at as well. All right, that's all for me today. I hope this video has been helpful. Once again, leave me a comment, leave me a like. Don't forget to subscribe. Tell your friends. Down in the description too is some links for books and websites and other option scanners and things that I think could be helpful for you as an option trader. So read through the description below. All right, this is Lee Lowell. I'll see everyone in the next video.